Hey everyone, we got some huge news from SoFi as management gave investors a quarterly update. So in this video, I'm going to work through those highlights and explain or discuss what they could mean for SoFi stock investors. So let's take a look at these details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so SoFi Technologies CFO Christopher Lapointe said that they achieved GAAP profitability this quarter for the first time, with GAAP net income reaching 48 million, which was an 88 million improvement year over year. That was impressive to be sure. SoFi stock investors were waiting all year to see the company deliver profitability on the bottom line. SoFi delivered on that promise, so investors were happy. The company talked about the segment level activity. SoFi operates several different segments, starting with lending revenue, which increased 10% year over year to 347 million and generated a 226 million contribution profit at a 65% margin. This was up from 209 million year ago. As we're going to see, the lending side of the business is the biggest part of SoFi's business. It generates the most contribution profit. It's the most important part of its business. It incorporates the most risk for SoFi stock investors. This is the area where I spend a great deal of attention when I'm analyzing SoFi stock, because this is the most important segment for SoFi stock investors. So the quarter resulted in an average net interest margin of 6.02%. That was up 3 basis points from the previous quarter and 8 basis points year over year. Before I move on, let me explain what the net interest margin is. So SoFi gets money through several means, one of which is customer deposits, which SoFi pays between 4 and 5% in the most recent quarter. And then SoFi takes that money that it gets from customer deposits and it makes loans. Then it charges customers an interest rate on those loans. The difference between what SoFi pays customers for deposits and what SoFi charges customers for loans is the net interest margin. That's what SoFi is in business to do. Take money from customers, make loans to customers. And the better it is at that core activity, the better it will be for SoFi stock investors. I know SoFi stock investors pay a lot of attention to the tech segment or the financial services segment. Those are going to be less important than how good SoFi is in this core activity. A bank, that's the core activity. SoFi is now a bank, and its prospects are dependent primarily on how good it is at this activity. Getting money from customers and then making loans to customers, how good they are at earning a profit in that activity. So it was good to see that they generated a 6.02% net interest margin and that the net interest margin was increasing. Now, also in the quarter, they attracted $2.9 billion of customer deposits compared to making $1.6 billion of net loans in the quarter. So they got more deposits than they made in loans. They got more deposits than they made in loans. That means there's $1.3 billion of excess money that's not earning. What SoFi chose to do was to use less of other facilities to generate capital. Because remember, I said customer deposits are not the only way the company gets money. One of the other ways that the company gets money is through warehouse facilities. And so they reduced how much money they were getting from that source and used more of customer deposits. And they saved in that process because customer deposits are its lowest cost of capital asset. So they try to focus more on utilizing customer deposits and less on warehouse facilities. And going forward, SoFi is going to be more cautious in 2024 in making loans. Now it can use more of its customer deposits and less of its warehouse facility to make loans in 2024. So they can utilize that difference, although there's a limit to how much they can expend in that category. And then they'll run out of that and they'll start generating excess customer deposits if they don't continue making loans. And they mentioned they're going to continue tightening and underwriting against strict credit standards. and they saw typical seasonality and intentionally planned for lower originations in their personal loan business, with originations of $3.2 billion, which was up 31% year over year, but down 17% from the previous quarter. SoFi did prudently decrease lending. If I was a SoFi stock investor or shareholder, I would be happy with this move. I am not a SoFi stock investor or shareholder. I don't own the stock. But what happened in the most recent quarter is default rates increased, and default rates have been increasing throughout 2023. Default rates were extremely low in 2020, 2021, and 2022 because customers had more cash than usual. Remember all of the stimulus money that was sent out during the pandemic? Loans were paused, student loans were paused, various other payments were paused, government benefits were significantly higher. Customer balance sheets were in much better shape. And as economy normalized in 2023, default rates started to increase. That's a troubling trend if you're a SoFi stock investor. The company has billions and billions of dollars of loans outstanding, and if customers are defaulting at a higher rate, that's not good news for SoFi. I like this move to decrease lending. As they observe this happening, they're taking the prudent approach and saying, oh, wait a minute. We've got to stop giving out as many loans. We've got to be more strict in terms of who we're giving loans to, because we're starting to see this trend worsen, and we don't want to give loans to those lower credit borrower scores. Even though SoFi focuses mostly already on high credit score borrowers, they're being even more strict now. And I would like that move if I was a SoFi stock investor. So I mentioned on the Q4, the balance sheet delinquency rates and charge-off rates continue as they expect to normalize back to pre-COVID levels. In other words, they're going up. This is management's way of nicely saying that default rates are going up. They're going back to pre-COVID levels. Where were they pre-COVID? They were much higher than they were during COVID. So they're going back to those higher default rate levels. In the fourth quarter, the company sold portions of their personal loan and home loan portfolios, totaling about $1.2 billion, approximately $875 million in personal loans and $350 million in home loans. Now, before you go thinking that, oh, that's good because that means SoFi decreased some risk because they sold those loans off of their balance sheet and now it's somebody else's problem. Before you go making that conclusion, let's take a closer look at the details. So these sales had similar structures to other recent personal loan sales, with cash proceeds at par or premium to par, with the majority of the premium comprised of the servicing fees that are capitalized. Here's the important part. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to exposure we would otherwise have had if we held the loans. The takeaway, SoFi still exposed to defaults from these loans that they sold. They include a small loss share provision. Loss share. That means the people who bought these loans got SoFi to agree to still take some of the losses from these loans that they sold. So even though they don't own these loans anymore, they're still exposed to the losses from the sales they made to these loans. If default rates increase and the economy worsens, all of these loans, the personal loans and the other loans that SoFi sold to BlackRock and others, can come back to bite them because they have these loss share provisions included where they can claw back and take back some of those shares of those losses. And these loss share provisions are above the base assumption of losses. So these are above what the base assumption is. That means they're going to give up more than is usual if there are losses in these portfolios. And if the economy worsens, as is expected, the economy worldwide is expected to slow down in 2024. In the US, the economy is expected to grow moderately between 0.5% and 1.5%, depending on the source you look at for the economic projections. According to SoFi's projections, they think the economy is going to contract in 2024. So they're expecting something similar to a recession in 2024. And if that materializes, then SoFi could be held liable for these loans. All right, so I hope this has informed SoFi stock investors a little bit more into what's happening inside the company. This news was significant, to be sure, and it really informs what's happening at SoFi. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.